Hello, good afternoon. My name is Mark Shaman, and I'm Associate Dean for Student Success in the Graduate School here at the University of Maryland. And I'd like to welcome you to this, which is the third in our series of 4 workshops on financial literacy. The Graduate School strongly believes that what you learn when you're in school about financial education can make a big difference in whether you become financially secure later in life. Today's workshop is by Dr. Jinhee Kim. She's a professor in the Department of Family Science here at the University of Maryland, and she's going to be talking about personal finance and planning for the future. Next week on Friday, we're going to have our 4th and final lecture in this series, and that lecture is going to be about paying off your student debt. So if you have student loans from undergraduate or from graduate school, I would urge you to sign up and to come next week for our final workshop. Without taking any further time, I'd like to introduce Dr. Kim.
Thank you. Thank you, Mark. Hi, can you hear me? Okay. I know we have only 1 hour, but I would like to briefly introduce myself. My name is Jinhee Kim. So basically, today, what do we do today for future? And there is a number of materials I will share with you later on via email where to get additional information about these topics. But basically, what we are here is to build wealth for the future. How to start and how to build wealth. And we all want to build wealth because when I teach undergraduate students, and I have few students, they say they refuse the idea about materialism and then wealth building, and then they're very, very against it. So they don't like the class and then some of the teachings. But overall, I think we all assume that we want to build wealth for our future, and it is necessary and it is critical. How do we start? Generally, financial experts or financial professionals, we start with where are your goals and how to set your goals. And to achieve the goals could be crazy or ambitious or anything you would like to do, but it has to be realistic. We'll go over about the goals, but it has to be a financial goals that you would like to achieve. And how do we get there? I know it is boring, and it is not really, I can't give you like exciting and zazzy answers, but budgeting or the day-to-day management, without that, it is really difficult to achieve what we want to achieve for the financial goals or wealth. And there is a part of the credit part, because the credit is now our report card. Without credit, it is very difficult to build wealth, because one of the couple of wealth building tools or escalators in our country are business, small business, or the business ownership or home ownership, or additional education, or the human capital. For these days, a lot of us, we cannot pay off with our cash, so we need to get credit to pay for those wealth escalators. So credit is, it's a very important part of our money management. And how to protect wealth with insurance. So we will be briefly covering why insurance is important. I know none of you has raised a question about the insurance, and that insurance doesn't seem to be directly impacting the savings or investing. But without insurance, we can't really protect the assets or the assets you are trying to achieve. So I will be just briefly going over types of insurance. And a foremost goal, we're focusing more about these slides about the first part, because that was a description of the workshop, but I will go over about the savings and investing, general strategies or general principles a lot of financial experts agreed to, especially for young people. So these are the overview of the workshop today. And basically what we want to hear, what we would like to achieve here is the building the foundation, financial foundation. So if you look at the bottom, financial plan, credit management, insurance, and then basic, if you look at the emergency fund, that is the savings portion. And once we achieve it, and eventually we would like to have all different types of investments. Some of the exotic ones on the top, whereas it may generate a lot of returns, but it comes with the higher risks. So we would like to be there at some point, and then I really encourage, and I have former students who sometimes emailing me about their exciting stories about their investment. We would like to be there, but without the foundation, we cannot be there. So that's what we would like to go over here today about the financial foundation. So these are the basically financial foundation, the financial planning, credit, insurance, and then savings, emergency fund. So financial values and goals. And we don't have a lot of time, but would any of you like to share about your financial dream or financial goal? Okay. I will share one of my former students who was a basketball player, and it was an assignment, and his financial goal was getting Rolls-Royce Phantom. And that was the first time I have ever heard the car existed, and it was like $250,000. So I didn't know about that. And that was his financial goal. And after reiteration about the goals has to be realistic, can you achieve it, or is it relevant, or whatever, he chose that as the financial goal. So there is a difference between the dreams and goals. And then I asked the steps to achieve their goals, and his strategy was being drafted by NBA. So anyways, I don't know. I didn't follow up. So I'm not sure he actually was drafted and he achieved the goal. But many times we would like to start with generally financial planners, any financial planners, any financial professionals you will see, they will start with what are your values and what are your goals. And we don't have only one specific financial goal. We generally have a number of goals you want to achieve, and it's over a different time frame. Some are short term, like saving for summer vacation, or saving for your car payment, or in the future, saving for down payment for your home, or saving for the graduate school, or sometimes it could be paying off your debt, the credit card debt, or the student loans. So generally, we start with a specific. What is your specific financial goal? So those are some examples of specific, and then measurable. And some students, some people say, like, I would like to save $100,000 in 5 years. But that's very ambitious. It's nice. But what is the specific purpose for that? And how do you measure your success? So you usually put the dollar amount for the specific. So if it was a financial down payment for the car, you could put the dollar amount for $5,000 or $6,000, and generally agreeable. I have 12-year-old daughter. I have 3 girls, and 12-year-old my daughter, she has a savings goal for the dog, doggy fund. So she wants to get a dog, and we've been working around it. But it's not maybe she's saving for it. I think she charged my husband and myself for various babysitting and household chores. So she's getting about $500. But is it agreeable for you or family members or any people who are involved in your life? So they generally, if you have other members that, or is it agreeable to your, values? And as I mentioned earlier about the realistic, if you want to save $6,000 a month to save $1 million in 10 years, many people, that is not a realistic goal. And generally, we need to put a time bound. It could be 1 year, it could be 6 months, or 2 years. But we need to put a time so we could measure we are successful in terms of achieving our financial goals. And these are some of the long-term, intermediate, and the short-term goal. And then I want you to think about what are your long-term goals, generally 5 to 10 years or longer than that. Or the intermediate 2 to 5 years. Generally, short-term is less than 2 years. But depending on your situation, some of the young people have a shorter time frame. So their short-term maybe 6 months. But it all depends. But I want you to think about the financial goals you would like to achieve, a couple of them. So how do we, smart ways to set and achieve goal? I think I'm glad some of you mentioned about technology. And this was like in a vision board. You need to be constantly reminded about your goal. If you want to achieve the goal, generally you want to be surrounded by the goal and then reminded by goal. But these days, do you look at the bulletin board? No, what do we look at most of our time? our phone, right? So there are some tools like using technology. This is called the Piggy Mojo. Have anybody heard of it? So you can check the Piggy Mojo, and this is all driven by behavior economics or behavior finance. People are irrational. We don't have a control to save. So what tools can help us save or invest more for the future? Our savings rate in the United States is about 4%, but it increased after recession. People are tending to save more. So the Piggy Mojo is you set up the savings goal. You have when you are going to store, and I need the nail polish. It's $10, and then I think it will increase my self-esteem, or it will help me with dealing with anxiety and different things. But when you don't buy that, you send a text to Piggy Mojo, and it's a $10 savings toward the savings account. And then when you send the text to the Piggy Mojo will send a text to your friend or your whoever family member, so they can encourage you for the savings. Currently, it is not connected to your bank account. I think some of the financial institutions are considering. So when you send a text to the financial institutions, when you don't spend the money on the nail polish, or I used to buy a lot of lipsticks. I have only but anyways, some of when you get stressed, and sometimes I'm not a hoarder or I'm not a compulsive shopper, but sometimes we all have weakness. So when you do that, then it will motivate and continue. So there is a jar you can see. So when you continue to save that, it will show you how much you're saving over time. So it is all to help us, because many of us, a lot of us have weakness, and there are a lot of temptations. Another thing is called STICK. It is not particularly only limited to the financial management. It's the smartest way to set and achieve your goal. And so you put the goal at stake, and then you put the stake on it. So let's say your goal was saving $500 or $1,000 before summer vacation. And then we all have that goal. But in reality, we may not be able to achieve that goal. But when you don't achieve that goal, if you decide to save $100 this month, and when you don't do it, what's to lose? It's what's to lose, right? Sometimes nothing happens. So we'll do next month. So this time with the stick as stakes. So either there's a penalty money we'll send to your friends. So if you don't achieve the goal, the money can go to your friend or family members, or the charity. And they have another alternative is, I think they're very creative, anti-charity. So for example, you are strongly against so you are pro-gun owner. And then you are putting the organizations for the anti-gun ownership. So it's going to work that way. So or the environmental, or pro-environmental. So you can think about that. So it's sometimes I say to myself as well, it's like, do we need that kind of punishment, or do we need that? But sometimes it works. So STICK is not just only about the money. It's also about they are doing the weight control, smoking cessation, and exercise, all kinds of things. So these are some of the tools that you may want to look at, and you may not need it. And generally, so we talked about the goals, and we talked about some of the how to manage goals. But there is a boring stuff about the financial statements. Why? Because we need to know where we stand present, and then where we were in the past, and where are we going in the future. So the first, we will talk about the balance sheet. It's to find out what is your net worth. So what are listing all of your assets, and then listing all of your liabilities. And don't be disappointed if you have a negative. Yes. At your life cycle, with the student loans and the debts and the earning right now, it is very common for young people to have a negative net worth. And then many older people have negative net worth as well. But what we want to do is to boost your net worth. And that is where we are here. So you can do, but without knowing where you stand. I mean, I think what we generally recommend people is you do the net worth statement every year on your birthday or first day of January or whatever day you choose, and then do annual review of your net worth. So you want to see the trend of growing net worth, not going down. And sometimes sometimes you are borrowing more and more from the student loan to pay your education, and up to the graduation and getting a job point, your net worth may be going down, but that is okay. But we will talk a little bit more credit management, but you want to have a plan for it. How many years it will be on a downturn, and how many years it will take for that track go to the the positive sign. And as I mentioned earlier about how do we build net worth, the most important thing, and a lot of people agree, is we need to have education and skills to get a stream of income, constant income. So to generate the income, to build the wealth. And I mentioned about the couple of the important tools to build wealth, because making money, earned income, is really a hard way to make money. Those people who have money, they don't work for money. Their money works for them. So we want to be in a situation like that. So your money work for you, not you yourself work hard. I mean, including myself, right? So I'm working, I'm relying on the earned income as well. So I want you to think about those, tools. How are you going to build the tools? Generally, there is a story I share, So there is a story about this millionaire and the reporter, and then some people were asking him, how did you become a millionaire? So he was telling the story that after Great Depression, he lost everything he had, and he polished, he bought an apple from the market and he polished it. And then he sold it, and the next day he bought 2 apples and polished it. So then the reporter is waiting. So, how many apples did you sell? And then he says, I was just selling, while I was selling apples, I met my wife, who was a millionaire. So that was the, wealth building tool. It's not a joke, because it's like, either you have a large inheritance, that's a good way to build wealth, or finding a wealthy, spouse. But unless you are, that's okay. If that's a financial goal, you have to have a plan for it. So probably those people who are not millionaires, you don't want to be associated with those people, right, to get there. So, but anyways, it's a joke. But for the couple of tools, where do you get there is generally, those are inheritance or the marriage are rare cases. Some people are chasing, but most of us, how to build wealth. We buy a house, the home ownership. A lot of millionaires, because one person asked about the book. I can recommend you a couple of books, but there is a book called The Millionaire Next Door, which is kind of dated now, but the principles stay the same. So they track those people who are millionaire. There are people who are millionaire who drive fancy cars and live in nice houses, but the majority of the millionaires in the United States are those people who live next door, who live modestly, and then who had, asset building tools. Many of them are, the business owners. So the business owners have a higher chance. Not all the business owners, but the business ownership is one way to build wealth in the United States, and there are more opportunities than the other countries in the world. And also home ownership. And then for all of us, we're trying to achieve improving our education to increase our learning potentials. So those are some of the things why we are using the net worth, why we're using the balance sheet, where we are, and then where we are going. So we talked about the balance sheet, about the present. Balance sheet is a snapshot. Your income, your assets or liability change every day. So it's only snapshot for the present. For the past, in order to find about how you earn the money, how you spend the money, we generally use the cash flow statement. So you track your income and expenses and find out, did you have net gain? or if you spend less than what you earn, which is very difficult to do in the United States. A lot of people are spending more than what we earn. So if you have a positive, that's a very good sign, that gain. But a lot of people have net loss, because that means they are living, beyond their means, or they're spending more than they earn. So how to track income and expenses? So people use like the papers. Some people use Excel. Some people use like Quicken softwares. Some people use all different tools, and then telephones. But it is important to track all of the income and expenses. I mean, if you forget one thing, just don't kill yourself. But still, it is important to track all of it. Does any of you, because if you like to share the tools, the tracking income and expenses tools you are using, any of you? Yes. Okay, Word document. Okay, yes. I mean, whatever works for you, it works for you, right? Okay. Anybody else? Yes. Mint? Okay, that's good. Have anybody used Mint? Okay. How is it working for you?
That's good.
Okay, it's good so far?
I set it up and tracked it for a week and then forgot about it.
Okay, so see, exactly. So it's being consistent is really hard. I mean, same thing. We'll talk a little bit more about the tools, about the online tools. And then next we would like to talk about the budget. Why budget is important. Generally, researchers like me, we find having written goals and written budget is helpful to successfully achieve your financial goals. And then we generally record the planned and then actual income and expenses and see the differences. Are we on track? For planning the income and expenses, it's based on your financial goals. What was your goal? Does your goal, did you incorporate your goals in the budget? So the budget is the plan, planning to meet expenses in given time. And then you want to think about what's important to achieve your financial goals you have, long-term, short-term, or intermediate, and what it will take. And then, what do you want to achieve in your life? So these are some of the budgeting, the logics for the budgeting. And I mentioned about the millionaire next door, and they do have control of their expenses. So these are the general tools you can use, Word or anything. And for it, I will just go over quickly because I would like to more talk about the savings a little bit later. So for the graduate student, if your goal is saving $6,000 in next 3 years, you need to save $250. Wherever you put these days, you will get 0.01% or 0.1% savings. So it's not going to work. But in order to put $250 savings in her budget, this is her current budget, and pretty good because she is still doing net gain. She's not losing money on that. But where do you cut money to save $250? You have to cut down somewhere, and you have to look in really hard. But many times, some are not possible to cut because you can't cut rent unless you are a very good negotiator with the landlord. And you can't really cut down your, insurance or different thing, fix those expenses unless you're changing the contracts. So many times what we can cut is those flexible expenses. And if you cut $164 plus the net gain, you can save $250. So these are generally how we start, when you have a set of goals and that, know where you are and how you spend the money and then put them in a budget. It's not very exciting news, and I know, so I would like to give you one answer to, find out to become a millionaire, but there are a bunch of boring ways, not too much exciting ways. So how do you manage your budget? So some people use the envelope method or the jar, whatever. So you put the money that you will spend for that week or for that month, and then you are spending only that much. Sometimes the anecdotal evidence. Some of my students say they didn't do all of it because they're using all the debit cards, but they found it was working for them for the entertainment. So they put the entertainment money fund only in the envelope, and then they spend only that much money for that week. So you don't have to do everything in the envelopes, and you may have a bunch of envelopes, you may lose cash, and that there's complications. But you may try to do some of it, and it's been working. It was found working. And somebody shared about the Mint.com. For those online financial management tools which became very popular, there are concerns about the security. A lot of consumer advocates, we have concerns about the security issues, and it is burdensome to enter all the data. So you have to link everything to the account and things. But even though upfront cost, many people find it very effective and helpful. But you don't have to do it. But you don't have to do it, but you may want to try if it works for you. And there are a number of other online financial management tools you can use. And these days, some of the bank, they offer it as well. So the Bank of America or some of the banking institutions, they offer those online management tools. At this time, I would like to share this Building Wealth. It's published by the Federal Reserve Board at Texas, Dallas. And then they used to have like these worksheets, but they developed the app. So you can try it on the app or the CD-ROM for the software. But you want to be careful about any advice you get. Before I just wanted to mention about one thing. So who are behind those educational materials, right? So generally, there are objective providers. But even then, Federal Reserve Bank, they are providing objective information. But who are they? The banks. So if you want to, think about some of it, so you want to get the information, and there are a bunch of materials produced by Visa or MasterCard, or the American Bankers Association. There are a lot of materials out there, but you want to be very careful about who are providing, what are their major mission. So you want to check, verify the sources as well. Because I teach a number of courses for the caseworkers so they can help their clients. And there is a very popular financial education curriculum called the Money Smart, which is developed by FDIC, but FDIC is the Federal Insurance Corporation. So they are regulating the banks. So a bunch of their materials about the banking, how important is banking. As I studied, research about the financial services are important, but it's not for everybody. So when you get the information, that's why I really want to encourage you to seek additional information and then, determine if it's going to work for you or not. Some of the information I share as well. I'm not selling anything. I'm not promoting any particular materials. I'm trying to be unbiased, but still, whatever works for you, it's a personal finance. So that's one thing I wanted to share. But the Building Wealth is, they talk about number of key topics. They're important for the wealth building. And it is an app. The app is not too exciting, but still I think it does what needs to do. Next, it's really boring about the organizations. So how many of you filed taxes on time? Oh, great. So how many of you, because I did a free tax assistance program on campus. I'm providing the service. So I did we're finished by April 15. But there are a lot of people, they find they don't file taxes on time because the first fear is they think they owe money to IRS. But the majority of people, they are not organized. They don't have materials get ready. And even though I'm not promoting any business organization or organizational skills, in personal finance, getting record organized is very important because you lose money on it. And that you pay more, and you will lose money on it if you don't have all of the documents ready. And also, we generally recommend that you have a duplicate copies and hard copies, not just the files or electronic files. And then at times, number of things happen and you may not have access to it. And we will go over a little bit more about the insurance. Some people use, because we recommend you have a homeowner's insurance. If you're renting, you want to have a renter's insurance to protect your assets. Because if you live in an apartment, it's not going to protect your assets or any belongings inside the rental unit. So you want to protect that. It is not too expensive, and you can get it from your car insurance provider, or talk to your parents if they can help, because you may get a cheaper rate. But when you have the insurance, you want to have all the records as well. And some people recommend like videotaping it, so you know what it is, you know where it is. So those are, it's not about the money, but it is related to money. And then I know, how many of you attended the credit workshop? Okay, so I don't want to repeat what was said, but some of us were not, some of you didn't attend the workshop. And as I mentioned, credit is really important in money management. So for the understanding credit, credit is not free. You're borrowing, and then at a very expensive rate. And so it is important to understand student loan, car loan, any home loan, anything, any loan, anything you get money that it was not yours, then you have to pay hefty fees and interest. And then even with paying all of those interests, they will verify if you are worthwhile to loan the money. And that's how they determine the terms or whether they will loan you money or not. And the credit is, credit is a big issue. Credit is now, some researchers, some people argue, is it another, redlining? Because credit is the minorities or the young people or the international folks or international students or the immigrants, they tend to have a lower credit score, and they tend to have, more issues with the credit. And when you determine that you need the credit to achieve your financial goals in the big picture personal finance, that's very important. You have to put everything in that picture before you make that decision of borrowing. You need to choose carefully. So if you have noticed, the Federal Reserve, if you remember the big recession, the banks got bailout money, and then what do we get? So we got something, because the credit Reform Act was been trying to be, we tried to pass the bill since the 90s, nothing happened. But after economic crisis, people were really mad about the banks, right? So that passed. But if you look at the credit card statement, now they will tell you how many years to pay off the debt and how much you pay for the interest, and those are the additional information we achieved from that, economic crisis. Addition to some additional the insurance protection under FDIC. But choose carefully is many people don't understand. And I had one international scholar, and then he bought a car at the rate of like 15%. I don't know where he got the. So anyways, so like some people like 15% or 10% or 18%, it is just a number. And people don't, and then the time of crisis, it does not matter. But choose carefully. Not everything is the same, and that there are terms that are generally not favorable for consumers, and then certain people are, targeted in negative marketing as well. So choose carefully, read the fine points, and it is very important to understand what you are getting into. And then once you have access to credit, and when you determine you need the credit, you really need to use it, wisely. For the example of student loan, it is important, and it is very fortunate that some other countries in the world, they don't have student loan. But they don't have access to, they can't access to the education. But in this country, you can get student loan and financial aid to, and there are a lot of hurdles, and I have to admit, but there is a way to get the education without cash or without the savings. But when you borrow the additional money, you really have to think about how long it will take. And then generally, some of the rules are, do you remember the financial statements I talked about and the budget? some experts say if you are paying the debt payment more than 12 to 15%, depending on the expert you talk to, if you're paying 12% to 15% out of your income for those credit card or the car payment, you're approaching in a danger zone. But many of the college graduates, when they get a job, if you think about their student loan payment, they are over 10 to 15%. So they can get a car loan, because if you think about the student loan amount you will be paying and then add to the car loan or any other credit card loans, it will be really, you are going to be in a danger zone. And then, so if you are thinking about buying a house, they also look at the mortgage payment. So generally, depending on the lenders, if you get some subsidized loan from the government, you can do like 28 to 35%, depending on, it used to be up to like 41%, but these days 41% of your income can be spent on the debt or housing related cost. But now it's more like 28% to 36%, but depending on the lenders. So do the math. So if you want to buy a house, if you think about the salaries or the income you will be bringing, and think about the debt payment you will be paying out. And if you are thinking about the place where you live or you desire to live and the cost of the housings, then if you do the math, probably you may have to think a little bit about getting additional debt, because it's going to restrict the flexibility in your future, because it's going to be coming out of your money, your income somewhere, and then the longer it takes, the more you pay in terms of the interest. So that's the one thing. Yes.
Just really quick. So you said between 28 and 36% is optimal, or like the maximum limit? That's
the maximum limit. So if you can do less than that, it's even greater. Mm-hmm. But many of us, so they look at the ratio. That's the back-end ratio or the front-end ratio the mortgage lenders are using. So you have to submit how much debt payments, the car loan, student loan, furniture loan, whatever loans, and then the mortgage, and then the mortgage related to mortgage interest and the insurance and taxes. So if you add all of those, it has to be around that much, the ratio that they're aiming. And then monitoring credit is very important. Over half of the for people who have credit report, they have some errors. My last name is Kim. So if you met any other Korean named Kim, there are a gazillion Kims and then Jinhee Kim. So I used to live in Westchester Park high-rise building. If you know, on the Kenilworth Drive, it's a high-rise. Means there are a bunch of people with the same address. So those cases, the credit report, they are supposed to use your social security card, social security number, your date of birth, and the full name and everything. But the mix-ups happen a lot of times. I get calls for the debt collectors in my house saying like, oh, are you Janice Kim, Joyce Kim, Jenny Kim, on all different, John Kim, different reiterations. But they got some information from somewhere, so you really want to check. And then we all got the email from what happened to the University of Maryland, right? So you want to check your credit. Yes.
So there are, as far as I know, 3 sources that you can get a free credit report from every year.
Yes.
Are they entirely free? Okay.
Yes. These are. So the credit bureau, I know you talked about the credit already. So they are collecting information, but who's providing the information? Credit card companies. Or the retailers, the lenders, so they provide the information. So do they have to? Do you think it's their best interest to be most accurate and in any? It's not their best interest, and then it's billions of information gathered every day. So you want to check. And there is I don't want to go too deep into the credit, but this is the credit, like freecreditreport.com. That is a commercial site. Even though you like the jingle, you don't have to go there. So the annual credit report.com, it's monitored by the Federal Trade Commission, which the federal agency that enforces the Fair and Accurate Credit Transaction Act. So you want to go there, and you can get information. And some people will ask, is credit score included? even though we were successful getting this credit, report act passed after the, whatever the economic recession, the credit score is not included. So you have to pay for it. And then there are a bunch of, if you look at the website carefully, they're selling those credit scores because it's a big business. Credit monitoring, credit score, credit, credit report may be free. It is free. Once a year, you can get a free credit report from 3 agencies there. And then you can request everything. You can download the form, or you can input all the information from that website, and then you can get it online as well. However, for the credit score, some people ask, is it really worth it? And then is it really? But it's a very complicated issue with the credit score. But if you can check for once, but you don't need to check daily, because all the credit score, the calculations are done with the information in the credit report. So if everything is okay, the information is correct in credit report, you can, the generally credit score is correct. And another issue with the buying credit score is that different lenders use different scores. One of the most, known provider is the FICO score. And they have this black box. Nobody knows what's going inside. They say about the general information, how they calculate the score. But even FICO score is not only one algorithm. They have all different mechanisms to calculate. And then you don't know which one they are using. Generally, for those credit bureaus, they're selling their own credit score. Some provided using the FICO algorithm, some are not. So if you are not really serious about seeking mortgage or car loans right now, you can do once, but you don't have to pay for, for monthly. Yes,
I heard from someone, I've always paid off my credit card every year, every month. But I was told that you're not technically borrowing at that point. If you're always just paying it off, you're never really borrowing, and you need to at least be late on a payment at least once in order to. Is that
be late? No. No, you don't want to be late. Yes.
Or just always just paying it off still?
So some people say, there is activity is important. Okay. So you want to use it. And then there is another thing you want to know. When do they send the information to the credit bureaus? So even the billing date or the due date is 15th a month, and then you send it and then you pay off every month, which is a positive thing. But if they report 10th of the month, it will show the balance in the credit report, right? So those things are something you want to think about, and you want to have a current activities. But generally, if you revolve, meaning if you have balance on your credit, that's a positive thing for the credit companies. But it doesn't really. You can't be late. No, you don't want to be late. Yes. So I'll just briefly talk about the ID theft. Its important thing is, yes, not sure how to protect identity, from my identity. We do our best, but things happen. But we need to be vigilant about it. And generally, if things happen like the ID theft, it was not like the data breach. That happens as well. But sometimes people lose their wallets and they find weird activities on the credit report. Then we need to do it. And you need to have a police report in order to do anything. And generally, to clear off from the ID theft, if somebody used your ID and then get the credit cards and 5 cell phones and borrowed any other loans and then do everything, to clear that off, it will take years. And then you thought you cleared it and it will come back to you. So it's really no right answer. And then there are the credit bureaus. There are a lot of lawsuits against the credit bureaus because they were supposed to clear any mistakes and corrections, but they refused to do it. And as I mentioned earlier, the transactions are so voluminous, so nobody has accurate information. It's not the original creditor. People sell debts to other debt collectors. Collector A, Collector B, Collector C, Collector D, and they don't have all the original information. So it is really complicated. So you are, really want to be vigilant what you can do. But I have my friend who is a Purdue. Her son was telling me that the high school students. I know he's like starting computer engineering program next in the fall. But he says he can get like any social security number for anybody. And then he told me that like especially public university professor, our information is just out there. So there are things we cannot control, but these are the things you want to be vigilant about it, and then make sure that you want to have a fraud, report and things. But many times, a lot of ID theft are happening in low tech. Happens done by the family members, friends, neighbors. So if you look at the incidents, those high-tech incidents the rate is not as high as those low-tech people you know. And you need to file the complaint with the FTC about the ID theft. And they have a bunch of videos and then tools they can help you. And as you probably heard from when we had a data breach in our university, you can put an alert, initial alert, extended alert, and the military personnel have different additional protections as well. And some people use credit freeze. And if you are a victim of credit ID theft, you can do it for free. If you are not ID theft victim, you can pay some money to do the credit freeze, meaning that you don't want to they cannot open your access to your credit. You just froze it. So you have to pay to reopen it, but it is worth protecting it in case you know that you are not in a market for loans in the near future. And there are a number of ways to stop those marketing pre-approved cards. And there you can stop those solicitations as well. You cannot do it forever, but you can do like 3 years or 5 years. You can stop those solicitations because when they send you the pre-approved cards, they check your credits. So those inquiries are not supposed to harm your credit score, but you don't want to be exposed if you don't need to. So these, we talked about it. I'm trying to get to, these are some of the information. I can share the slide with you. So I just want to repeat some of the information that were shared at the last credit session. But most important thing is the payment history. One of the most important principles of the credit management is pay on time. Even if you cannot pay everything, pay on time. And how much you owe is important. And then credit history length. So younger people have a lower credit score because they have a shorter length of credit history. So many people encourage some parents don't agree that they don't like their kids to have a credit card. Some of the college students, they are telling me the parents told them not to. I know that's a very good decision, but in terms of credit management, if you start early, your history will be longer compared to your friends or your counterparts. And there are, seeking new credit is going to important, and what types of credit you have in your credit. So those are some of, yes,
So applying for credit affects your score.
Yes, yes.
So you need to be careful about.
Yes, you can shop during the window of the time. So if you look for a car, do you want to look for only one lender? No. You can look at 5 different lenders. They will access your credit. 5 different lenders will access your credit. But if that happens during the shopping, the window time, 45 days, then that will count as one inquiry. So you need to shop. You want to shop, but you don't want to apply for, different time.
Can you repeat that? So if you at 5 different companies within 45 days and it's only one inquiry.
For the car, they can identify that as this person is shopping for a car loan. And then there are 5 inquiries or 7 inquiries. Those inquiries took place within 45 days. Then they will count as one inquiry. So it's not discouraging you from shopping. But if you do it every month, if you go to different places, open store cards, and if you want some of the sweepstakes, they check their credit report as well. So you want to my daughter wanted to sign up for, Mom, I want that whatever car or whatever the sweepstakes. I learned that they're checking, some of them they're checking credit report too. So those things you want to be careful. Even the cell phone companies, they check your credit. So those number of inquiries will lower your score. But if shopping is fine. So this is the one thing you want to, think about. The one other thing in terms of managing money, that payment. I mean, you want to pay on time, but if you pay only minimum payment, how long it will take? 11 years, 12 years, and then how much you pay in terms of interest. So if you think about it, I mean, that's something you want to do. But for the credit card company, they want you to revolve. They want you to borrow money. So the minimum payment requirement is bare minimum. So don't be distracted. I mean, if you can pay off, that's great. A lot of times we cannot do that, but you really want to have a plan to pay off. Compared to the interest rate you get from the bank, and the same bank charge what kind of interest rate for your credit card, then if you do the math, I mean, what is the priority? We talked about the insurance. And all of you, the highlighted ones are something we recommend for graduate students. For the life insurance, you may not need it. I mean, if you want to consider it, but you may not need it, especially those investment type cash value type of insurance. But the car insurance, the health insurance, renter's insurance, you may consider disability, but the car, health, and renter's insurance are something that you really want to seriously consider to protect your assets. And have enough coverage and shopping and check those, companies. Will they be there when you need them? I mean, you want to check their records as well. So let's briefly talk about the savings and investing. So the savings, once you took care of those foundations, savings is something you want to start with because the investing is a long term. But remember we talked about the length of time frame for the goals. So if you are thinking about long-term goals, you need to invest. You can't do otherwise. If you're thinking about 10 years of financial goal, such as retirement, home ownership, whatever, it will take longer than like 5 to 10 years. You need to invest. You can't just save. Saving is not going to work. But if you want to save for the intermediate, or sometimes the intermediate, or sometimes the short term, definitely you don't want to invest because you will, you may not get the even principles back. So for the savings and investings, the difference you want to think about is it's not just your preference. What is the time horizon you are looking at? Some people ask me, some of the organizations ask me that they have some money they want to really invest because the money is not doing anything, but they may need the money in 2 or 3 years. Well, then there's nothing I can do. There's nothing we can do if you need that money in a couple of years in the savings and putting in the savings. And then you need some of the money in the savings account, which is called emergency fund. So depending on your situation, generally we recommend 3 to 6 months of your monthly expenses in those savings account. I don't want to scare you I don't want to scare many people. If you don't have it, work toward it. And that could be your savings goal. So doesn't matter if you don't have it now. It doesn't matter. But those type of emergency funds should be in the savings. So when you lose the job today, you have money when something happens to you, like, for the car broke down or something happens, you need a new laptop, different things happen, you can tap into those emergency funds. So think before you go to the investing or, before you think about investing, some people, you may not want to wait until you have emergency fund savings goal achieved. You can do it at the same time. It's up to your situation. There's no one answer because it's all up to your individual situation. But the general rules are you can invest, but take care of some things first, but you want to have some savings before you're thinking about investing. For the investing part, so time is really with you. I know some of you are probably older than just college graduates, But if you say this is like there is a fine print, there is an assumption about the interest rate, the return of like 8 to 10%. But if you think about, if you invest $3,000 when you were 21 and then stopped, and then if you invest $3,000 starting at the age of 31 and then you stopped, the difference can be huge. So there are a couple of investing techniques and the principles you learn from the first class workshop, but generally starting early is the most important principle. Because if you are young, sometimes I talk with a different group, and then sometimes they may not have years to catch up. But you guys have the time. So I know you are just starting, and then you want to think about, student loans, all of those things. But you have time to start early. So some of you have questions about where I put the money. I talked to you about the savings account or the savings money market account, anything related to it. And other things I generally recommend to young people, if you don't have a 401k plan at your workplaces, do you see that, the index card? That is everything in your one index card. So those, everybody agrees, those key principles they're not a lot. But some people can think about it. So if you have a 401k plan or equivalent employer-sponsored retirement plan at your workplace, you want to do it. And you want to contribute. If you can contribute a maximum, that's great, but not very few people can do it, that's okay. And if they are matching for your contributions, you need to contribute at least that much. And then you want to be very careful about what are the terms for the contribution. Some employers require vesting, means you have to stay there for 5 years to cash those, to get the employer contributions. Your contributions don't go away, your money. But if they matched it, some employers require vesting. So even though you don't like the boss, you may want to stick around until you're vested. Another thing, what you could do is generally individual retirement account is available. And for young people, Roth IRA is really great tool. I know we don't have a lot of time to go into. If you don't have a Roth IRA, if you have an earned income, like even as early as 13 or 15, a lot of people, they start contributing to their kids' IRA account. I have a 12-year-old daughter, and I'm waiting so I can, I can make her work somewhere and then get some earned income so I can start her in a Roth IRA. Because of the time. So 401k plan is you are not paying taxes right now. You get tax deduction, but you pay later. But for the Roth IRA or Roth 401k, you're paying taxes right now, but you're not paying taxes later. But do you remember this chart? How much you have originally put in and how much you're getting out later? Then how much will be the tax consequences? So for young people, I know 401k is very good tool. And some people, and I think I recommend it, but if you don't have it, but think about the taxes you're paying for the red bar or the blue bar. So if you look at the differences, it's not too much to pay taxes now, especially your tax bracket is not too high. So that's what a lot of experts recommend about the Roth IRA. And then Roth IRA, there are jokes about you can get Roth IRA with, putting money and investing in the gold bars and all different things, but not promoting gold, or the, precious metals. But you just put the Roth IRA money in the bank accounts, all the gold bars. Generally, we recommend about the mutual funds. If you are learning to invest money in individual stocks, that's great, but you don't want to play with your serious money. You can play with some of the money that you can lose, but the serious amount of money that you cannot lose, you cannot sleep at night if you lose them, putting in a more safer places. So that's the recommendation for the Roth IRA. And then when do you start? Do you start now? Do you start until I pay off the student loan? Do you start until I have enough emergency fund? It all depends. If you're paying off, if you have a $6,000 or $10,000 credit card debt, you're paying 18%. Then do you want to do you want to pay that off first and then getting like 3 to 5%? So it all depends on your individual situation. But those are perspectives you want to consider when you are making a decision now for the future. So I think I ran over about 5 minutes, but I'm here. I'm glad, I'll be glad to answer any questions you have.